morning, everybody, and welcome to our Connect 2025 Winter webinar. For those of you who haven't joined our Connect sessions before, the aim of this event is to create a network of support for paraplanners, advisor support staff, and those of you who are usually working behind the scenes. So we especially aim to support those of you studying towards chartered status, tailoring content with detailed studies to help and learn and put information into practice. So just as a reminder, we do bring our Connect events to in-person in summer. So we're visiting Manchester and Leeds. So if you're close by those regions, please keep a lookout for more details to follow in coming months. And if those regions aren't nearby for you and you'd like us to bring an event to a city near you, please let us know on the feedback form. And if there's enough demand, we'll look to expand the in-person tour and come a little bit closer to home for you. The feedback form will automatically pop up for you at the end of the webinar. So we'd really appreciate it if you took the time to let us know your thoughts, and we really do use your answers to tailor our events in the future. So please do use that form to let us know what you think. So the session today will also be available on demand. So if you'd like to recap or pass on to any colleagues, we'll provide a link for you to use post-broadcast. Full details will be in your follow-up email, along with a copy of the slides and your CPD certificate, which will be supplied based on your time in session today. I'll be joined today by some fantastic speakers, including Head of Public Policy, Rachel Vey, Junior Portfolio Manager, Manan Goyal, and our Senior Tech Consultant, Joshua Croft. So for now, I'll make a kickstart today and kick off the webinar with a quick business update, tell you a little bit about what's been going on here at AJ Bell on the advice side, and including a little bit about a new exciting project that we've been working on. So as I say, guys, I'm going to kick off today with a very quick business update just on a few of the bits and pieces that we've got going on here at AJ Bell, particularly on the advice side of the business. So a little bit about us. We're a FTSE 250 company, up to 96.1 billion in terms of AUA at the moment, 1,400 plus employees over our 3 office locations, mainly in Salford. Vast majority of the employees are based up here in the office. 5th largest platform in the market, over 600,000 customers now, and over 8.1 billion in terms of the AJ Bell investment range. So just going strength to strength in terms of those numbers, and that's been consistent. If I take us back to FY16, which is when we re-platformed, so it's kind of a nice time to look forward from. It's clean, linear growth year on year in terms of our customers and in terms of AUA that follows from that. So that's all organic growth. We've never purchased a book of business. It's just about getting the fundamentals right, having a good support structure at a good cost, and these things kind of naturally look after themselves in terms of customer growth. So if I see what that translates to in terms of business figures, I've got our financial year 24 results here. So our business year runs from October to the end of September. So we will have our FY25 results very soon. They're due to land at some point in December. So in the next few months, if there's another session and we've got another one of these, you'll see some updated figures that I'm sure will post another nice positive set, because FY24 gave us growth in terms of retail customers. It gave us growth by 21% in terms of AUA. Most importantly for us, revenue and profit before tax, you can see, was up 23% and 29%. Really important for us because that's what we can then take to put back into the business. We don't want to stand still. We're always looking forward. So we want to improve on the things that are already good in terms of support structure. We want to always add new technology, new additions really to the proposition that might help you in terms of advisor firms using us and make your life a little bit easier. So I'll touch on that in a little second, what we've got coming. So despite some of the difficulties that everybody has faced over the past 12, 18 months, 2 years, we've not been immune in the cost of living crisis, with increasing our distribution spend, our technology spend, our operational spend. Obviously the building, the electricity, the staffing costs have all gone up for us. But that just again speaks back to the level of strength that we've got in terms of the overall proposition for us to still be posting the kind of profit numbers that we are, and we can still continue to deliver rather than struggling at the moment. So that's all underpinned, as I said a moment ago, by our service. It's always been the kind of #1 thing that we've prided ourselves on here at AJ Bell. So in terms of our advisor support team, if you was to call that team, you're getting an answer 94% of the time within 20 seconds throughout the year. And if I look to August, 99% of those calls was answered with 20 seconds. Emails, 95% generally answered within 24 hours. Again, looking at August figures that I've got here, it's 99% of those were in 24 hours. So you're speaking to a human being, you're getting an answer to your question, and you're generally getting supported when you try and get in touch with AJFL. So the development journey, and harking back to that profit figure I was lingering on, we've had a lot drop in since I think January 24. These are probably taken from. So if I look at our new client onboarding journey, it revolutionised getting new business onto the platform for us. It's as streamlined and as easy as ever. Really useful tools in there, sort of multi portfolios in ISA and GIA, so now you can operate a bucketed approach within those wrappers. Regulars into models, and a lot of the general model dealing we've dragged from the old funds and shares site onto V2, so it's much slicker now for you managing your investments with us. Online gilt dealing has been really useful over the past few months to a year, let's say, with the CGT reductions, ring fencing of cash. So all really useful tools that we've dropped onto the platform, and we don't want to stand still. We're always looking forward to look at the next phase of what we can bring on board. So I'm actually really happy to say that some of these on the up next journey have actually already landed. So, well, Woven advice, at least we've locked in with Woven. So anybody looking to do a mass migration from a different platform to AJFL, Woven can streamline that journey and take away a lot of the legwork for you guys involved in tidying up any of your back office data. So if any clients is missing policy numbers, valuations, anything key that you would need before moving them, that highlights that information at basically a click of a button, so that you can then cleanse your data, get a nice clean starting point. It will then do a cost comparison for you. It can help write suitability letters, and it can help push data forward. So if there is anybody out there reviewing a potential platform move, please speak to me afterwards about how Woven might be able to help you in that process with us. And then the onshore bond with Countrywide Assured, very, very imminent at the time of recording. That should be live very, very soon, where you'll drop our GIA into an onshore bond, and that ticks the final box for us in terms of wrapper choice. If I move forward a little bit to the rest of what we've got on there, it's all about automation on the platform. So we're working on auto invest and auto disinvest, so that once you place in a piece of business with us, we will essentially do the rest in terms of managing that cash and managing the investments for you. The first tangible piece of the puzzle will be our simplified bed and ISA process, which again should be really very imminent. So we'll be in touch with everybody, letting you know when that is live, but hopefully very, very, very soon we'll have a one-stop shop process where it will sell from your GIA, move to your ISA, and purchase your portfolio in the ISA. That's the first piece of auto invest that you'll see on the platform. We can then drag and drop that technology onto ISA and GIA to get it started on those wrappers. SIP will be a little bit further down the line after those two wrappers, because there's the extra SIP cash pot for us to move. But essentially, we've got a full plan in place then for auto invest, and auto disinvest is probably just a tiny, tiny bit behind that, but roughly similar timescales, where you'll see it on ISA and GIA first, and then it'll flow into the SIP. So watch this space. We'll keep everybody updated as and when the developments land, but we're very, very close, and there's a lot of work going on in the background to get a fully automated journey in the not too distant for you. So if I take us to what we offer on the platform for now, then full range of family planning wrappers that you can house all underneath the same roof. So really useful for advice firms that you wouldn't have to have different wrappers on different platforms, particularly for family members or individuals. Everybody can be in the same place. Somebody can then log in and see everything under one roof on your client login. So traditional SIP, ISA and GIA, where the ISA is flexible. We've got a range of junior products, junior SIP, junior ISA, the lifetime ISA, which as of the recent budget is going to be shut down at some point. So yeah, only existing license for now, so we can probably remove that. GIAs to go into offshore bonds, onshore bonds, limited companies, trusts, pension schemes. So really flexible GIA, whatever structure a dealing account could sit in, we can likely drop our GIA into there. So a bit of something for everybody. And within all of our wrappers, you have access to our funds and shares service, which is the platform essentially. So you've got access to the funds and shares service at 20 basis points on your first 500k, 17.5 basis points between 500k to £1 million, 0.15 between £1 million to £1.5 million, 0.075 from £1.5 million to 2 million, and then we fee capped at £2 million. So any really high value cases, it essentially works out at a fixed fee of £3,000. So the more those assets grow and the higher the case size gets, the lower the overall basis point gets. So really attractive for any particular high value cases that you might have. The outlier to that is our retirement investment account. Long story short, if it's a hark back really to when we was just SIP administrators, everything was the pounds and pence quarterly administration fee. So when we dropped our funds and shares in there and essentially created the platform, £200,000 was the line in the sand that we drew and said, we're making enough on 0.2% custody, we can drop our traditional SIP quarterly admin pounds and pence charges. So below 200, you might have paid 0.2 and an admin charge, and above 200, you were just paying 0.2. So we birthed the RIA from that to make it more attractive for us towards that lower end of the client spectrum, where under £200,000, you would just be starting at 0.25%, nice, clean, all-in charging structure for the RIA. So 0.25 is the highest you'll ever pay. Most clients should sit within that 0.2 tiered charging structure. So the funds and share service, we've got one of the widest range of access in the whole platform market. After we bought a stockbroker, it was around 2016 that we did that. So you've got access now to over 4,000 unit trusts and OICs, ETFs, ETCs, structured products are not on here. You've got government bonds, direct equities, gilts. So a vast range of what you might look at to fill your full proposition. There shouldn't be anything that you can't access really via AJ Bell to tick off all the boxes of your CIP. And within all of those building blocks, it's been kind of the age of MPS over the past few years. So we've got an ever expanding list of third-party MPS options. I think we're up to around 40 now in terms of providers, and we've got most of the mainstream providers in the marketplace. If there's anybody that you're looking to access that isn't on the list, please get in touch with us, and we can see if they're in our next batch for review to get on board onto the platform. And if not, we can maybe start discussions to see what we can do on that front, if it is a business blocker for us. And then a slide here, I mean, we've picked out XO and gilt trading specifically, but I suppose it's just more a general USP slide in terms of a couple of bits and pieces that we can do that some other platforms can't. So XO being one really interesting one, where there's been a lot of self-trading or sort of client dabbling really with money over the past year or so. So within all of our main wrappers, SIP, ISA and GIA, you can drop an XO pot where you could siphon off a certain portion of money for your client to do some self-investing. You can see exactly what they're doing. So most importantly, they're not taking it away to trade in 212 or somewhere else, making some risky choices that you don't have any visibility on, and the risk that they're not really telling you what's going on with that pot. So you've got full visibility, but you can't trade on their pot. They have full visibility of your pot, but they can't trade on that. And you can keep everything under one roof, more importantly. And gilts has been another interesting one with the reduction in CGT, because there's been a big opportunity in the marketplace, particularly around secondary market gilts trading below par. If you can purchase those gilts and hold them to maturity, the vast majority of the gain is coming from that difference between purchase to maturity price, and you've just got a small coupon in the middle that is taxed, but your gain there between purchase to maturity is predominantly CGT free. So you can either trade on gilts directly on the platform, or we've just built a range of gilt MPSs. We've got 3 portfolios, depending on the client's time horizon. They'll mature in 26, 2027, 2028. And as gilt MPS 1 closes to new business, we'll introduce gilt MPS 4, which will mature in 2029, and so forth. We'll create a ladder approach where you should always have a choice of 3, essentially buy it, hold it to maturity, really low cost, and the vast majority of the gain in there, as I say, is exempt to capital gains. So really interesting for any particular clients that you might have with high GIA levels. More info on that, please get in touch after the call and we'll arrange something separately. Data integration, more important than ever in the age of technology. So we feed in automatically now to most of your mainstream back office providers. A couple of new ones keep propping up. So as and when anybody does prop up, or if there's somebody on here that you are looking to use and access that doesn't tie in with it automatically, please let us know. And again, we'll engage in conversation. But most of your mainstream providers, we can automatically feed in valuations, advisor charges, and transactions. So migrations from other platforms, I've already touched a little bit on Woven as part of the developments. So essentially, we've got an in-house team and an in-house process where we can review with you as a firm how a migration might work. Everything's quite bespoke because no firm is the same when it comes to migrating clients. So we'll work with you on the easiest way to get them from A to B. But if we drop the Woven technology on the top of that, and the biggest benefit being it's completely free of charge to you as an advice firm for accessing that. If you're moving clients from A to B with it, it will do a lot of your analysis in terms of client details and costs, and then help with you each process and take a lot of the legwork out. So as easy as possible nowadays for you to be moving clients around if there's a platform that isn't quite ticking your boxes. So again, please get in touch with myself or your regional business development contact after this call, and we can see how Woven might work for you. So the last thing I'm going to touch on today is AJ Bell Touch. There was no pun intended there. Brand new proposition that we brought to marketplace this year, and it's something a little bit different to AJ Bell Invest Centre. So it's geared towards simple need clients, probably clients that would fall into this advice gap that we're seeing a lot in the press at the moment, where they might not necessarily have enough funds under management at the moment to warrant your full advice process. They might be a little bit younger, where they don't want that traditional advice process and they're quite happy to do everything via their mobile phone. So Touch for a client is completely app-based. So how it works for you as an advisor firm, you would build your proposition on an advisor-only website the way you would do now with a lot of the normal mainstream platforms. That gets sent directly to your client, first as an email to say download Touch because you've got a proposition from your advisor waiting. Once they've downloaded the Touch app, their propositions start waiting for them, so they can review what you've put together, they can confirm it, you've got a full audit trail captured then on the Touch app. And then as part of that proposition, if there was a transfer, let's say part of it, as soon as they've confirmed it via the app, Touch will go out and initiate that transfer. If there was a top up involved, Touch can link with major banking apps straight away, so you don't have to take a reference number to a bank and make a payment. It will open up NatWest immediately for you to type in £20,000, submit, that drops immediately into Touch, which is then invested in whatever funds you've chosen. So streamlined A to B, straight through processing, all app-based for your client. There's a messaging function between yourselves and the clients on there where we see most of the communications taking part, and it just gives you an extra tool in your kit box to service those clients, as I say, that maybe would have fallen underneath your traditional minimums, maybe would have fallen into the advice gap, maybe just want something a little bit more like Touch. So again, if you want to see a demo of the platform or have another chat around how it might work in for you, get in touch with myself or your regional business development contacts after this call, and we'll have another chat. So that's it for me today, and that's what we've got going on in the advised world. Thanks very much for your time, and I will move on now to the rest of the session with some of our other speakers. So now for our second session this morning, our Head of Public Policy, Rachel Vey, joins us to discuss the changes brought by the 2025 budget, and that took place at the end of November, and she'll highlight the main points of focus which could impact you and your clients.
Hello, my name is Rachel Vey, and I'm Head of Public Policy here at AJ Bell. Today, I want to cover the 2025 autumn budget and the changes coming out of it, which are going to affect pensions, investments, and savings. Well, it was a long time coming, this budget. We had 12 long weeks to wait for it, in between it being announced and it actually happening. And that long lead-in time gave way to a long, intense period of speculation, where we heard so many rumours about things that were going to happen in the budget. Unfortunately, this level of speculation drove many clients to make some decisions, and some of them might have been rash decisions that they may have later regretted. For example, taking out tax-free cash. In the end, this was a really big budget and an important budget for Rachel Reeves and the Labour government. Rachel Reeves said that she had three main priorities. She wanted to cut the cost of living, she wanted to cut the NHS waiting list, and she wanted to cut the cost of debt. There were over 80 policy announcements in this budget. There were some which particularly caught the eye, for example, increases in minimum wages and minimum living wages, which is going to have implications for employers. There were also some big announcements to public spending, and the one which really grabbed the headlines was scrapping the two-child cap on child benefit. Alongside these big headline announcements, there was also a range of tax changes. Probably the most important to your clients is the Reeves freeze. This is extending the freeze on income tax thresholds for another 3 years to go up to April 2031. That would have meant there would be 10 whole years where the tax thresholds and the national insurance thresholds mainly didn't increase. Now, these are some information from the Office for Budget Responsibility. The blue line at the top of that particular graph is the tax receipts. And you can see that more and more tax is being gathered in because of these changes or this particular policy. The yellow bars is the number of taxpayers. Now, obviously, as tax thresholds are frozen and people get pay rises, then more and more people are becoming taxpayers. And the OBR predicts by 2031, there will be 5.2 million more taxpayers. There will also be 4.8 million more at higher rate taxpayers. 4.8 million more, and by the end of 2031, over 10 million higher rate taxpayers. And that's a third of the working population, so a really big proportion. The table on the right-hand side of the slide just shows the some figures and some illustrative figures for how much more people will be paying over the next 3 years. So as you can see, it really is going to hit some people hard. So what can you do to help your clients through this? Well, there are various ways and means, and I am positive that you've already been speaking with your clients about these tactics, about helping them manage their income so that it doesn't get grabbed into the next higher marginal tax band. One way to do that is to top up on pension contributions to lower the notional rate of income. You can do that using salary sacrifice, but I'm just going to come back onto that in a second or so. Another way is to give gifts to charity and charitable donations. And again, that might reduce that headline income figure. And a fourth tactic is, if you're speaking to small business owners, then to reshape remuneration, maybe to cut down on the salary, but instead pay through dividends. But again, I'll just come back to that one in a couple of minutes' time. So let's go on to salary sacrifice. Well, we were all worried about particular changes coming in for pensions. And there was a lot of rumours, as I said, and a lot of speculation beforehand. These mainly centred on tax changes to pensions, for example, cutting the tax-free cash amount or bringing in a single rate of tax relief. But in the end, the government decided to tackle salary sacrifice. Now, pension salary sacrifice is going to continue. That is the good news. But what the government wants to do is to put in a threshold, and that threshold is £2,000 of salary exchanged. So if somebody exchanges more than £2,000 of their salary for an employer pension contribution, then that amount of salary, that excess amount, then both the employer and the employee will have to pay national insurance contributions on that amount. Now, it's important to say that salary sacrifice is still a really tax advantageous way for people to pay pension contributions. And importantly, employees will still save on income tax. So there are really many reasons why people should continue a pension salary sacrifice. The government expects to bring in some large amounts of money for this. The figures on the right-hand side show 4.7 billion in 2029-30 and 2.6 billion in 2030-31. But the Office for Budget Responsibility admit it's difficult to actually pinpoint the numbers, and there are going to be some behavioural aspects to this. That's partly because the legislation and the change does not come in until the 6th of April 2029. Now that gives us 3 years to consider what to do before it comes in. The government, though, is keen to indicate to the bond markets and generally, I think, that they are determined to carry this one through, that they're not going to go back on this. So we're expecting legislation in the next few weeks on it, draft legislation. So how is this going to affect your clients? Well, as I said before, it's only the excess above 2,000 on the salary exchanged for a pension contribution. but both the employee and the employer are going to have to pay national insurance contributions on that. So taking it in a really simple form, let's look at this table. The notional salaries are on the left-hand side. So someone who's earning £40,000, if they're paying a 6% contribution, decide to sacrifice that 6%, which is 2,400. So they give up that 2,400 salary, and instead it's paid as an employer contribution. The excess over the cap is £400. The employee has to pay national insurance on that, which is £32, and the employer has to pay national insurance as well, and that's £60. Now, as you can see on the right-hand side, as the amount of salary goes up, then the cost to the employer goes up. So that's how you would expect it. It's 15% of the excess that's worked out as, and it's really quite simple. It just goes up in line with salary. But if you look at the employee line, the reduction in take-home pay, then you can see that it doesn't follow a progressive plan here. It doesn't follow a neat line at all. It goes from 32 to 56 to 80, and then right back down to £26. Now that's because somebody who's earning £50,000 is paying 8% on the national national insurance contribution. And somebody who's earning £55,000 is only paying 2%. And that's just the way that their national insurance contributions have been set up. So actually the category that gets hit the hardest by these changes are the ones who are earning between £40,000 and £50,000. So as I said, we've got 3 long years to look at this change coming in, to think about it, and to make sure that both clients and employers make the right decisions. For a client, if they, as I said before, salary sacrifice, pension salary sacrifice is really tax advantageous. And even if it's a little bit of excess over the £2,000, up to £2,000, it is still very tax advantageous. So clients, if they've got the opportunity to take advantage of pension salary sacrifice, should really think seriously about doing that. They may also want to increase the amount that they sacrifice between now and April 2029. And if they're able to sacrifice bonuses, again, that might be an idea to do that now whilst that offer is on the table. For employers, they may want to think about what they're going to do going forward. Are they going to scrap the whole salary sacrifice arrangement, or are they going to just keep it in place for the first £2,000? And I'm sure both pensions and payroll software are all going to be set up to allow that to happen. It doesn't affect everybody. If anyone's earning less than, say, £40,000, then it shouldn't really affect them. £40,000 with a 5% employee pension contribution shouldn't really affect those people. But the median earnings in the UK at the moment is £39,000. So by the time we get around to April 2029, I would have thought that figure would go up to, say, £42,000 or £43,000. So as you can tell, it's not affecting the lower earners. It's not affecting maybe the very low earners, but it's affecting median earners, and it's affecting the higher earners as well. Employers might decide to do something different. They may decide to reduce their wage growth over the next few years and to give higher employer pension contributions and to work it out like that. But if employers are thinking about doing that, then maybe just a word of warning to think about employment law as well. And also the legislation that we're going to get coming out on salary sacrifice might include some provisions to try and stop people from mitigating the effects or navigating the system. Some changes for pensioners. Well, the state pension is going to go up by 4.8% in April 2026. This government is definitely committed to the triple lock, though. Now, the fact we have a frozen tax threshold makes this very interesting, for want of a better word, over the next few years. You can see from the graph below that the tax threshold is going to remain frozen. That's the orange line. The blue line is the state pension. And I've assumed some increases based on the OBR earnings predictions and the inflation predictions over the next few years. Now, we expect the state pension to overtake the personal allowance threshold in April next year. The Chancellor said on live TV, Martin Lewis programme a couple of weeks ago, she said, well, if that happens, then those people who are getting the state pension won't have to pay tax because it's going to be too little and too fiddly to collect, so they just won't have to pay tax. We're not going to make them fill in a self-assessment. We just won't collect the tax. Now that gives rise to a whole range of questions and some accusations of unfairness. For example, someone currently getting, say, the basic state pension plus some additions through SERPs could be over the current personal allowance and could have to be paying tax currently. Or somebody who doesn't quite get the full state pension but has a private pension, but that takes them to the same amount as the state pension. They would have to pay tax, whereas somebody who's just collecting the state pension wouldn't. It's also on an intergenerational basis quite unfair as well. Somebody could be earning the same as the state pension, but would have to pay tax, whereas a pensioner wouldn't. So I think there's all sorts of problems within that. One last thing to mention on this is that the state pension age is due to start rising from April 2026. This has been coming for a number of years, and I think sometimes we forget it's actually going to happen. But over the next 2 years, the state pension will gradually go up on an incremental basis, a month-by-month basis, and go up to 67. We're also going to see some big reforms to ISAs. Now, the government wants people to stop relying so much on cash as a saving and move to investing more. And preferably, as far as the government is concerned, they want to invest in UK equities. So the government reckons that the best way to achieve this is to cut the cash ISA allowance down to £12,000. And it intends to do this from the 6th of April 2027. I don't agree with this. I don't think it's going to give rise to the effect that the government hopes for. When we asked people back in March, what would you do if the government cut the cash ISA allowance? What would you do with the rest of your money? 3/4 of them, 75%, said that they would put it either in a different type of savings account or in premium bonds or NS&I. And that's probably what you would expect. Only 1 in 5 said, well, actually, what we would do is to invest it more in the UK stock market. This isn't the only way the government wants to increase UK investment. It wants certain platforms. It's entered an agreement with certain platforms that they will host a Invest in Britain hub. I haven't got a lot of information about what that means at the moment, but some way of hosting an area that really encourages people to invest in UK equities. The government is also hoping that targeted support can turn our nation of savers into a nation of investors. It's going to run a national campaign as well at the beginning of next year, possibly into ISA season. And this campaign is going to go forward and explain the advantages of investments to people. And the government also wants to look at risk warnings and to change the way that risk warnings work. So hopefully FCA can get on board with that as well, because that's changing, moving away from the statement of your capital is at risk, which people see everywhere. But I don't think many people really understand exactly what it's telling them. Now, because the ISA cash allowance is going to go down to £12,000, that sounds nice and simple, except it's not. The full allowance is going to be kept for anybody who's age 65 or over. But this leads into another whole range of complication as well. Now, to stop people from gaming the system, from just putting their money in stocks and shares and then transferring it over to a cash ISA, the government has come out with 3 different ways that they want to stop people from doing that. So they're going to ban transfers from stocks and shares ISAs and innovative finance ISAs to cash ISAs. These three rules, by the way, they only apply to people who are aged under 65. There's going to be some tests to assess whether the investments held in a stocks and shares ISA or an innovative finance ISA are eligible. So they're not cash-like or investments, or not cash in another name. And there's going to be a charge on the interest paid on cash held in the stocks and shares ISA or an innovative finance ISA as well. So they're going to look at that. So 3 different rules coming in. Now, this is going to mean that the ISAverse is going to get suddenly very complicated. Now, that's as if it wasn't complicated already. But we're going to have a cash ISA for those under 65 and one for those over 65 because different subscription allowances. Different rules for stocks and shares ISAs for people under 65 and those over 65. The same for innovative finance. Lifetime ISA, we've already got 2 different types, one for cash, one for stocks and shares, and the same is true for junior ISAs as well, one for cash, one for stocks and shares. Now, in case you hadn't forgotten, and I don't think for one single moment you had, we also have a Help to Buy ISA that people can still pay into. And I'm going to come back onto this in a second, but it looks very likely that we're going to get a Help to Buy Mark II ISA as well. So as you can see, that is a very crowded ISAverse, over 12 different types of ISA. Now, lifetime ISAs, the government wants to look at that. It's going to consult in early 2026 and on bringing in a new product, a simpler ISA to support first-time house buyers. Not one to save for retirement, note, just one to support first-time house buyers, and one where the bonus is given on the purchase of the house rather on when the subscription is made. Now, I think that lifetime ISAs do need reforming. I would like to see some real key changes to that, but I think this particular approach sounds even more complicated, and it sounds like a return to the Help to Buy ISA. I also worry what's going to happen about the self-employed. Many self-employed people out there, if they're under 40, can use the lifetime ISA, take out a lifetime ISA to help them save for retirement. And obviously there are people over the age of 40 who are using lifetime ISAs to save for retirement. I think that the ISA regime needs a whole reforming, and we need to really take a step back and think about what's the better way of simplifying this very complicated regime. A few key changes for inheritance tax coming in April. We've got the changes to property, business property relief and agricultural property relief. One thing that came out of this year's budget was that the 100% relief up to £1 million can be transferred to the spouse. The IHT threshold is going to be frozen to 2031. That shouldn't come as a surprise to anybody. Another key change is on inheritance on pensions. Now, this is definitely coming in April 2027. And up to now, the government had written the rules so that the pension beneficiary could have asked the pension scheme to pay the IHT. But the personal representative who is liable for the IHT, working out how much it is and actually is liable for paying it, they couldn't ask the pension scheme to pay it out. So the government, the HMRC, wants to change those rules to say to the personal representatives, well, if you know what the IHT is, then you can ask the pension scheme to pay out before they pay out the pension beneficiaries. And if you don't know what the IHT is, then maybe you can ask the pension scheme to keep half the pension benefits back, just in case the pension beneficiary then needs to just in case the pension beneficiary takes all the money and wanders off with it, and it's difficult to try and get it back off the pension beneficiary. So some little changes, little adjustments that should make it easier to pay IHT from pensions. Some other key tax changes. Now, there are 4 different tax changes here, and they're coming in different times, different time scales. The savings rate of tax is going to go up by 2 percentage points to 22, 42 and 47, and that's April 2027. The dividend tax rates are going up for the basic rate and the higher rate, and they're going up by 2 percentage points as well. There's no change for the additional rate level. You're already speaking to your clients about moving assets, shares maybe into tax wrappers to shelter them from dividends, but it's always worth having that conversation. There's going to be a new property income tax, which is going to be at rates of 22, 42 and 47, and that comes in April 2027. Now, because we're getting a new tax, that's going to unsettle the order of taxation, which order you take which tax off first and that sort of thing. This could have implications for your clients. It's a really techie thing to mention, but it's probably worth noting that's happening. And then finally, we're going to get a new mansion tax. This is going to be a high value council tax charge, and it's going to apply to houses that are over £2 million. It goes up in 4 different increments. It starts at £2,500, and the highest charges are £7,500. It's not coming in until April 2028, but they're not going to use the council tax bandings, which are currently there, which are sometimes 30 years out of date. Instead, they're going to use the 2026 valuations. They're going to use some new valuations to work out which houses fall into which categories. One final thing to mention is changes to VCTs. Now, VCTs are a useful way for some of your clients to invest, and they're getting a change. They're going to increase the size of the company that VCTs can invest in. So to move away from the entrepreneurial small business owner to much bigger schemes, much bigger companies. Now, that's the good news. The bad news is that the tax relief for VCTs is going to be reduced from 30% to 20% from next April. There's still going to be tax-free dividends, so it's still worth considering, but I think we really need to work through the detail to figure out whether it's what it actually means for your clients. My final slide is to leave you with a timetable of change. And as you can see, there are several things coming in different times, making it quite a complicated environment, quite a complicated outlook for the next few years. So lots of changes to discuss with your clients about what's come out of the autumn budget. I really hope that whistle-stop tour has proved useful for you, and it only remains for me to wish you a really happy Christmas and all the very best for 2026. Thank you.
Thank you for that, Rachel. A very insightful session there, I'm sure you'll agree. And if you have any questions for Rachel or any of our speakers today, please put them in the chat box or on your feedback form that will pop up for you automatically at the end of the webinar, and a member of the team will get back to you with an answer. So next up, we've got our junior portfolio manager, Manan Goyal. He's taking us through the importance of proactive bond market management, and he'll explore why this is essential for achieving stable returns and mitigating risks. And this really closely links with the J10 module of the CII exam syllabus.
Well, so lately you might have noticed that bonds have stepped outside the financial newspapers and just into everyday headlines. So bonds were once the introverted cousin of the markets, and now they hold the center stage. They're almost giving a warning sign to policymakers around the world, almost as if an ultimatum: mend your ways or we will force you to. A few points here and there on the yield curve can send ripple through economies and have long-lasting implications. So how exactly do you manage bonds in your portfolio? What are the basic concepts you need to look out for to build an optimal portfolio for your clients? So over the next few slides, we'll try and cover these basics and find out how bonds fit in your portfolios. So you must hear about yields, duration, spreads a lot. Everyone talks about them, but what do they actually mean, and why are they so important? So one of the most important concepts for bonds to remember is that bond prices move in opposite directions to interest rates and yields. We will build on this and clarify this as we go on. So if to start off, bonds can serve a lot of purposes in your portfolios, right? They can act as a diversifier, they can help with income generation due to the fixed nature of coupons associated with them, of course, and they can help with capital preservation. So traditionally, investors have used bonds as a portfolio diversifier rather than as a sort of engine for returns. Long-term investors typically accept lower returns from bonds relative to equities, of course, just to get sort of a ballast in their portfolios. So to say, an asset that's uncorrelated to equities or lowly correlated to equities now, that will outperform in unfavorable markets when there's a drawdown in equity markets or when risk goes out of favor. So negative stock-bond correlation in the past has allowed for that traditional 60-40 portfolio, 60% equities and 40% bonds. But as we can see from this chart on the right side, the red line shows that if S&P 500 is going up, a basket of global bonds is going down. And if S&P 500 is going down, a basket of global bonds has gone up when measured over a 3-year period. Well, if we look at it since the Great Recession, though, the stock-bond correlation has fluctuated on whether the market has a palette of risk. So it has changed quite a lot. Whether investor concerns are tilting towards inflation or economic growth, or just fiscal policy, that has changed correlations throughout history well. And historically, this has served investors well, because in periods of equity market drawdowns, they always had bonds to shield their portfolios. But as we can see towards the end of this chart, since COVID, this has changed. It's still a low correlation, but it's a positive correlation now. This does not mean that bonds still don't fit in your portfolios. We'll discuss this throughout the session. Bonds can still very well help manage your portfolio goals, even with this positive correlation. So if we focus on bonds as diversification, if we think back to the sell-off during COVID in 2020, global equities lost around 20% in just a matter of days, as we can see from this slide. Now, if we look at bonds during the same time, they served as a diversifier and provided a much needed tailwind to the portfolios as interest rates started falling. Remember, we talked about in the first slide the relationship between prices and interest rates, how prices move in opposite directions to interest rates. Essentially, bonds rose in value as central banks throughout the world floored interest rates due to COVID. But this trend later reversed marginally, as we can see here. But if we look at this dark red line, a traditional 60-40 portfolio, a portfolio of 60% equities and 40% bonds, provided a much smoother journey for the investors, just highlighting the importance of bonds as a diversifier in stress scenarios like the one we saw during COVID. Now the purpose that bonds can serve in your portfolios is for income generation. There's essentially 3 points to cover for income generation. Most bonds usually have regular coupon payments. Bonds pay periodic interest, which is typically semi-annual for government bonds, annual for corporate bonds, which provides a predictable income stream for investors. The second point is coupons associated with bonds typically have a higher stability versus equity dividends. So coupon payments are contractual. That means that bond issuers have to pay coupons unless they default, of course, making them certain, which is different to the dividends paid by common shares. And the third point for this is matching income to liabilities, which is ideal for investors which need a payout schedule to cover their future liabilities, whether they want to take out their pensions in future or just looking to pay out for a house in the future. So if we go into the weeds of technical knowledge, we hear a lot about yields, but what exactly are yields? So essentially, yields are the compensation that the lenders are asking for to lend money. So for example, if I say to you that the yield on 10-year UK government bond is, let's say, 5%, that would mean that the market is asking for interest of 5% per annum to lend money to the government for 10 years. And like interest rates, yield also have an opposite effect on prices. So if investors are asking for a higher yield or return on their investment, the prices of bonds will fall just to provide that extra total return or yield to the investors. But yields also serve a much bigger purpose. So they also serve as an indicator. They serve as a vehicle for investors to show their disagreements towards governments or their fiscal policies. So, for example, recently in UK, we've seen the yields on 30-year gilts surge to levels not seen since the 1980s. As investors were using the forces of demand and supply to sell off those bonds, and they were doing so to signal their unease over the growing UK government deficit, or in other words, the amount the country owes to investors, and demanding a higher compensation to invest because they were concerned that future governments wouldn't be able to repay their debt or would struggle to service the interest on this debt. So why do these yields move? There are a lot of factors, more than you can count, on why yields move, but some of the most important ones are changes in interest rates, inflation expectations, economic growth expectations, supply and demand, like we saw recently, or credit risk events. So yields are on a more macro level. Now, if we look at a bond level, there's yield to maturity. Yield to maturity is a very important benchmark. It basically tells you the return you get if everything goes as planned. But there's always a catch. It is not the return you'll actually get. And all because of the unrealistic expectations, unrealistic assumptions the calculation makes. So if we look into them, first of all, yield to maturity calculation assumes that you hold the bond all the way to maturity. If you sell it early, your actual return would be completely different based on the sale price, of course. Secondly, it also assumes that you can reinvest all your coupon payments at the same yield, which in real world, it rarely happens in the real world. Interest rate changes, inflation expectations change, and your reinvested coupons might earn more or less than when you initially invested in that bond. It also does not account for credit risk events. If the issuer runs into trouble, your returns will be impacted. And of course, there's also taxes and fees that eat into your returns. So while yield to maturity is a useful benchmark for comparison and planning, it is not, to say, a crystal ball. It's more like a best case scenario in a very rational, a very perfect world that rarely exists. If we look at more technical factors that you need to look at while you're studying bonds, is duration. I'm sure you would have heard about duration in a lot of places. So what is duration? In broadest terms, duration is the percentage change in the price of a bond for 1% increase or decrease in interest rates. So if I say to you that the stated modified duration on a corporate bond is 4.2 years, that would basically mean that the price of the bond would decrease by 4.2% for every 1% increase in interest rates. Remember that inverse relationship between interest rates and bond prices. And usually bonds that sit lower on the credit quality spectrum have a lower duration, just to compensate investors for already taking a higher credit risk. So if we can see this from the table on the right side, it shows the duration on global corporate bonds is almost double as the global high yield bonds because they sit lower on the credit quality spectrum. So bond duration can be used to manage risk in your portfolios. So let's say an investor is concerned about rising interest rates. They may choose to invest in short duration bonds as they will be less sensitive to changes in interest rates. So why is it important to manage this duration? So this chart shows the reaction of long duration and short duration UK government bonds to 10 worst quarters for equities since 2000. So that the red line is the equity drawdown. As we can see from this black bar, yes, long duration has helped protect investors in a couple of drawdowns, but not across all the periods. In some periods, it has lost more than just the standard duration gilts index. Now, if we look at this pink bar, which is short duration has protected value in every single period of equity drawdown. Yes, it has not enjoyed much of the upside either, but it hasn't captured much of the downside, which could suggest that it could be suitable as a defensive position if you're looking for a cautious portfolio or if you're concerned about inflationary pressures. Then if we look at this chart, we can again observe how duration management is key to avoid large equity drawdowns. So the dark gray line here is long duration gilts. The pink line is the standard duration, and the red one is the short duration. Now, as we can see over the long term, since 1999, short duration has protected investors from majority of equity drawdowns. Now, if we come to the present, let's look at 2025 so far. We have seen a couple of inflation prints above consensus in the UK. The market has constantly been worried about long-term inflation uncertainty. There's been discomfort regarding fiscal standing of the country. And we can observe this via the performance of standard duration gilts and short duration gilts in this chart. The 3 points where inflation print was above what the market expected caused a drawdown in standard duration gilts, whereas the short duration provided a much smoother journey for the investors. Now, if we look towards end of this chart, the discomfort regarding the upcoming budget in November is prevalent in standard duration gilts, but not so much in short duration, which is providing a much smoother journey for your investors. If we look at credit spreads now, it's also very important in terms of when you move down the credit quality spectrum. So you'll hear a lot about how spreads are tight or wide in media. So what do these spreads actually mean? So essentially, spreads are the risk premium that investors require for taking on additional risk of a corporate bond relative to a government bond, which is considered a risk-free asset. So we can see this demonstrated in this chart, where the credit spread is essentially the distance between the yield curve of corporate bond and the government bond. This additional risk could be due to lower credit quality, high default rates, liquidity concerns, demand and supply, and many other factors, to be fair. So if I say to you that the credit spreads on high yield bonds is 3%, what that means is that investors are currently getting an additional yield or return of 3% over the government bonds if they invest in high yield bonds. Spreads are also sort of a key indicator of market sentiment. So when spreads are tight, it is considered a risk-on environment, and when spreads are wide, it is sort of considered a risk-off environment. We've talked about a lot of stuff that you need to look at while building a portfolio of bonds. So to bring everything together, we need to have a holistic view to build an optimal portfolio. First of all, you need to think about why are you adding bonds to your portfolio? What purpose do you want them to serve? Do you want diversification and protection from equity drawdowns? Maybe a cautious position in short duration bonds might be for you. Do you think inflation and interest rates are going to go down and want something to enhance your returns? Maybe long duration fits better. Do you want regular income? Maybe high coupon bonds. Then you also need to consider whether the market is compensating you enough to go down the credit spectrum. Are high yield bonds compensating you enough via spreads to make it worthwhile for you to invest in? If yes, why is that? Are default rates going up? Just to finish up, bonds can be a great fit for your portfolio, And hopefully this session gave you a good refresher on the basics of bond markets. But we have many more additional resources on the investment asset section of our website. If you have any other follow-up questions, please reach out to us. And if you want to find out how we manage duration in our portfolios and just the overall bond allocation in our portfolios, please contact your business development manager.
Thanks, Manan, and a really useful session there. Again, any questions for Manan or any of the other speakers today, just stick them in the chat box or in the feedback form at the end of the broadcast. We've got one final session for you this morning to close off, and it's our senior technical consultant, Joshua Croft. He'll round off the morning with a deep dive into the practical application of financial planning principles as outlined in the CII exam syllabus, with a particular focus on retirement and estate planning.
Welcome to the technical part of today's session. I'm Josh from the technical team here at Invest Centre, and for my section of today's webinar, it's going to be a slightly different format to how we sometimes run the technical sessions in the past. So I thought rather than just going into kind of technical tax rules and those kind of things that we do tend to do with these, look at it, maybe applying it more to a bit more of exam preparation and how a lot of these technical elements are actually examinated for in the diploma modules. I think a lot of the feedback we've had from previous events has been the main exam that people have kind of questions and want support in is obviously the RO6 exam, which is I'm sure you'll be aware is the kind of the final piece in the diploma exam suite, which is a kind of a 3-hour exam based on a case study where you've got kind of a free form answer format rather than the kind of multiple choice that's in the other exams. So it's quite a tricky one. I think it has the lowest pass rate because it is quite a complicated exam, and because it's the final module as well, it's obviously testing knowledge from the other 5 RO syllabuses as well. So it's quite a lot of information to retain and then put out in exam answers. So quite a tricky one. So I thought what we'd do today is have a look at a kind of an example case study, which will be similar to the ones that do get set on the RO6 exam itself, and then look at kind of what the case study tells us, how we analyse that from a kind of exam mark position, and then look at some potential model answers as well to some kind of exam mock questions. So this won't be kind of a comprehensive, this is how to pass RO6, but hopefully it'll be useful just to give you some of the elements to things to think about in terms of how to analyse a case study, things the examinators will be looking for in terms of giving marks. So there's always this kind of analyse, recommend, and then kind of back up that recommendation as well. So a lot of it will be based on that. So as I said, this is just something we've put together. It's not based on the actual CII stuff at all. It's just kind of as an example scenario, but hopefully it'll be quite similar to what would actually come out in the RO6 exam. So if you are looking at sitting that in the future, then hopefully today will be useful. So as I said, we've just come up with this scenario, but if you look at some of the past papers and some of the mock exams, lots of these case studies do tend to be along this kind of line. So the actual exam itself, there'll be 2 separate case studies, but we'll just look at one today just to make things simpler. So we've got our client's scenario here. So if we look at it, we've got David and Sarah, age 62 and 60 respectively. They've got 2 grown-up children. In terms of their employment history, David recently retired from a senior management role. Sarah is still working, but she's planning to retire within a couple of years. In terms of their health, they're both classed as being in good health, and they own their own home, which is currently valued at $650,000. So with this exam, the case study does give you a lot of information that can then be used to actually answer the questions as well. And because you get the case study ahead of the exam, it is worth going through it and looking at all the key elements from it. So even in terms of the non-financial information, just this simple bit that they've given us here, it's telling us some quite key information that we can use to actually answer the questions. So one that does stand out is that Sarah's working currently, but she's planning to retire in 2 years. So what we know from that is there'll be an income source that's coming in at the minute, but there's a plan for that income source to stop in that 2-year period. So again, immediately there's something there we can plan and analyse and actually come up with a recommendation around when we're answering the questions. things like the health aspects as well. So again, that's a key piece of information. They're in good health, they're in their early 60s. So again, we can use information like that when we are answering those questions in the future. In terms of other details then, so this is typically what you would receive as well. So David's got a defined benefit pension scheme, which is currently giving him an income of £38,000 a year, and it's classed as being index linked as well. So that will be going up with inflation, CPI or RPI, depending on the scheme. And again, that gives us some key information that we can use when we're answering the question. So we know there's a guaranteed amount that's coming to David in form of that pension, which will go up in the future as well. So again, that's a key piece of information. Sarah's currently earning £18,000 a year, but we know that's going to stop in a couple of years' time, or that's what the plan is. So again, we've got that information there that we can use when we're answering the questions. And another kind of key piece of guaranteed income that's going to come down the line is the state pension as well. So we know, or we can estimate what the state pension will be in a few years when they're entitled to it. So again, we can use that as information to answer questions in the future. So they're both looking at retire. Well, David's retired currently, so he's not getting his state pension for another 4 years or so. Sarah not for another 6. So again, we can put that into our plan when we're coming up with recommendations later on in the questions, to say that there'll be a period where they'll be without that state pension income, but we can then rely on it to coming in a few years' time. So again, just by reading the case study, you can kind of see where the questions are going to come from, even without us actually seeing the exam itself. In terms of their other assets, they've got ISAs valued at 220,000 with a mix of equity and bond funds. Again, common questions are around the kind of investment mix and the suitability of investments. So probably highly likely you'll see a question around that as well. They've got cash savings of £40,000. So they've got a liquid amount that's ready to go. So again, that will probably come into a question you'd expect. And they've both got their own personal pension entitlements. So David's got a SIP valued at 320,000 and Sarah's slightly lower at 150,000. And as we've already gone through, they've got no debt. So their house is completely paid off and there's no other major debts that they have to service from their income. So if you'd see this as a case study, it's quite clear where the exam questions are going to go down. This will be based on retirement and estate planning, you would expect, because of their age and because of the information that it's given us in that case study. If the case study was with someone slightly younger who's still in employment, then you can tell that probably the questions would be going along the lines of kind of income protection, things like that, things for building up investment income or retirement income, those kind of things. Whereas this, you can very much tell just from the case study that we are going to be being questioned on retirement planning and also that estate planning, IHT mitigation, those kind of things as well. So even before you've seen the exam questions, the case study gives you quite a lot of clues in terms of what we're actually going to be asked. So you can do all your preparation around that. So you can go into the exam in a good position, hopefully, to be confident to answer the questions when they do spring up. So in terms of what else will be available in the case study, so you'll probably have the objectives of the client. So this is trying to replicate what a real life client advisor interaction would be like. So this is kind of testing it in a kind of a mock way, but in that kind of real world fashion. So in terms of our case study here, our clients' objectives are to ensure a sufficient income in retirement for the both of them. So that retirement planning aspect, also looking at minimising inheritance tax liability. So that's kind of a big issue for lots of people now. So I wouldn't be surprised if that gets brought up in lots of the exam questions, because it is a kind of a key issue around financial planning now. Gifting strategies as well, so their options in terms of passing on wealth within their lifetime. So again, because that's one of their objectives, you'd probably consider a question's going to come up around that as well. Looking at their investment strategy, again, that's a very common theme that they'll test on in exams. So in terms of the appropriateness of the mix of investments, things like suitability, risk ratings, all those kind of things, which is quite heavily tested, you would expect in the exams as well. And then also looking at potential funding for long-term care needs as well. Again, that's another topic that gets brought up more and more. And then last bit of information that we get as well in terms of the case study. So both have got wills in place, which is obviously a key area. Standard wills though, so there's no kind of financial planning built into the wills at this stage, so they leave assets to each other and then passing on to the children, which would be quite a common thing. So there could be some planning aspects around doing something with the will, which might come up in the questioning. No trusts in place either, so the questions could be around looking at the appropriateness of adding some sort of trust planning in there. So within that you could answer questions around, you know, identifying your knowledge of trusts and things like that as well, because that's obviously included within the syllabus. So again, things like that might potentially be tested on. Concerns about rising IHT liability, so they're kind of on the cusp in terms of their assets of having a big IHT liability, so their property itself, so that 650 figure, and the rest of their investments put them very close to around the £1 million mark, which is where IHT does become a big issue. So and obviously they're in good health as well, so you'd expect that the assets would grow over time as well. So again, that's all things that you can build into the planning in the questions that hopefully come up. And then again, their risk, their attitude to risk, that will be detailed in the case study as well. So very similar to most of these case studies, they're comfortable with a moderate amount of investment risk, but they want to scale that back as they age as well. So again, that's a very common theme that you'll see in these mock papers, reducing that volatility as they age in terms of their retirement planning. So as I said, the case studies are really useful. It will contain a lot of the information that obviously they're going to get out of you in the questions itself. So you do get the case study ahead of the actual exam itself. So very much is worth going through it, looking for all that information that's contained there. So not just the kind of the numbers and figures, all that kind of other personal information, which also leads into putting together that financial plan, analysing their current situation, and then you can go into the exam with a kind of a list of things that you think potentially will be tested on or asked as part of the questions, and then you're in a good position to hopefully that those questions will come up and you'll be able to put that into practice in terms of the exam questions itself. So we put together some example exam questions based on that scenario ourselves. So as I said, these are kind of key themes that you would expect the examiners would be looking for, hitting on those main points around retirement and estate planning in this example. Obviously, if it was a different case study, the questions might be along slightly different lines, but this is what you potentially could typically see based on that that case study scenario we've just been through. So looking at their identifying their key financial planning issues. So that question really is just about analysing the case study, highlighting all the elements that the information that has been given to you. So that's that kind of review of a client's current circumstances and just highlighting all those points. So basically going through the case study and saying X, Y, Z applies to these clients based on their case study. So that's very much an analyse question. So again, quite easy to get lots of marks on that because, as I said, you've already got the case study, so you could potentially do that analysis work before you're actually sat in the exam and then just hopefully remember it all on the day. Second question, again around retirement planning. So recommend and justify sustainable strategies to meet their retirement income needs. So as I said, because these people are in their 60s, it was quite clear that it would be going down this retirement planning angle. So we've seen that information there. So we'll come on to some model answers or things to mention in the exam based around that. And again, because it was quite an estate planning heavy case study, there's probably going to be a question around reducing IHT liability as well. So what options can the clients potentially look at to reduce their IHT liability as well? So what planning products and options do they have around that? And then question 4 there, explain how gifting could be used in estate planning. So a bit of an extension on the third question, but that one's actually looking at gifting as a concept itself. So within that, that gives you the opportunity to potentially go into what the gifting allowances are, how they work, the time limits for those kind of things. So again, showing that you've got that knowledge and how that would apply in one of these practical scenarios. And then lastly, look at their investment portfolio, so how that's structured to meet their objectives. So again, that's a very common question you'll see in these exams, all based around risk modelling, that's suitability and sustainability of those investments as well. So wouldn't be surprised if you see that on multiple exam questions. So because these questions are quite open-ended, there's no real right or wrong answer, but essentially you'll be trying to apply as much of that knowledge you've got from the rest of the RO syllabus and analysing that case study to show that you've been able to analyse the client's example scenarios and then highlight the elements for that. So there's no kind of like model answer, but there's certain things that hopefully you should be mentioning in your answers, so touching on those kind of key points that get brought up in the rest of the syllabus as well. So that first question, as I said, it's kind of analyse the client's current situation. So there's different things that you can pick up from that case study. So the key financial planning issues David and Sarah face. So the key one I'd probably say would be that retirement income sustainability. So we know what roughly their picture is in terms of their income at retirement. There wasn't too much detail about their outgoings, so they've got no real debts, so there's no kind of fixed costs they've got outside of general cost of living things. So obviously utility bills, council tax, running cars potentially, what their how many holidays they want, those kind of costing things. But then outside of that, they've got kind of quite a large chunk of disposable income potentially, so you can mention things like that. In terms of looking at the actual case study itself, we know David's retired, he's got that defined benefit pension, so as I mentioned before, that's a key kind of guaranteed amount, so you can use that in any plan of retirement income to say that you've got this guaranteed amount that's there, and then they can supplement that income with their personal pension, so dipping into the SIP income itself as well. Potentially if they wanted to, they've got their ISA investments as well, so they've got tax-free potential income as well. So just identifying that they've got these retirement outgoings, but they've got potentially got that sustainable income to support their outgoings as well. Look at so the second point on here is the investment risk and volatility. As I said, this is quite a key element. So the investment portfolio, it was mentioned, it was a mix of equity and bonds, so probably looking at reducing that volatility as people go later in their retirement journey, so moving from or going through the asset classes that are available and looking at moving from less or reducing the volatility by changing the asset allocation within that. So primary example will be moving out of equity-backed investments into the more bonds, cash-like investments, those kind of things as well. The other key point that we can take from the analysis is that they have potential in an IHT exposure, so their property and investment portfolio is close to, well, it's above the nil rate band of the 325 figure. They'll have the residential nil rate band as well if they're looking at leaving to the children. Through part of the planning aspect as well, because of the spousal exemption, they can look at passing, when one spouse dies, they can look at passing their wealth directly to the spouse for the spousal exemption, and then inheriting their nil rate bands as well. So you potentially have £1 million be passed on to the children. So again, just identifying that that elements of planning is there to do as well. They've talked about wealth transfer within their lifetime as well, so they want to pass the wealth on to their children in the most tax efficient manner. So again, looking at whether the wills are appropriately set up, whether any trusts needed to be used at this stage, or just outright gifting as well for actually passing on the wealth in the lifetime. And then long-term care funding as well. As I said, this is a bigger area that becomes more prevalent. There's no provision currently for any long-term care costs, so again, that's something you could highlight as part of the analysis of the case study itself. So moving on to that second question, so this is all looking about their retirement income. So I've touched on a couple of these points already, but yeah, David's got his defined benefit pension, so potentially if we knew a bit more about their outgoings, that 38,000 a year potentially you could say would cover the kind of basic cost of living costs, so covering off their kind of day-to-day essentials, so that's a covered amount for that. If they did need further income expenditure, so they can look at dipping into their personal pensions through the SIPs. I don't think it's said whether the SIPs have been crystallised yet, so there might potentially be some tax-free cash element there as well that it could take. So again, you can mention that in your answers to sort of show that, you know, the options around retirement benefits. Using their ISAs as well, so combination of taking taxable income from a pension, so obviously David will be paying tax on his defined benefit pension. any income withdrawals from the SIPs will also be taxable, but then ISA withdrawals are obviously going to be tax-free as well. So building in a scenario where you're taking an element of taxable income, but using each of their personal allowances and then supplementing that with tax-free income from the pension scheme, from the ISA schemes, I should say. Again, that shows that kind of good planning and of how you're looking at all the various options with a planning outcome of lowering their tax liability as much as possible. The cash reserves, they've got that £40,000 that was just in savings. Again, having that liquidity there is quite useful, this sort of emergency fund. So for any short-term income needs come up, you've got that sort of fund there that's can be relied on to dip into should that come up. So again, just mentioning things like that, that's all giving nice ticks for the examiner for giving those extra marks. As I mentioned previously as well, we know the state pension is going to be coming in a few years for them. So again, that's another guaranteed amount. We can estimate roughly what the state pension will be based on the current amount with a bit of inflation linking. So you can say roughly they're going to have, let's say, kind of £12,000–13,000 a year each from the state pension as well. So again, you can factor that into the retirement planning to say within another 6-year period, this state pension is going to come into play. So there might be a period where you're drawing down on the SIP funds, and then you can turn that off as the state pensions come into play later down the line. So again, just building in that strategy, that financial planning for them. And again, just mentioning investment risk as well. So are the personal pensions invested in appropriate funds? Do they want to look to more cash generating options as well? So something that's paying cash, taking those natural yields, things like that. So again, just going through those points, looking at the case study, thinking of all the various options, and then you can start building up this retirement planning proposal, and hopefully that will evidence and you're kind of backing up why you've selected those certain options, which is what the examiners are looking for in terms of giving those marks out. Their third question then was around reducing their potential IHT liability. So looking at the options in a broad sense of what you can actually do to reduce your IHT liability. So again, I already mentioned this, but using the nil rate bands. So mentioning that there's a 325 nil rate band plus the residential nil rate band of 175. Again, mentioning how that can be transferred between spouses. So there might be an option of leaving things in the will up to the nil rate bands, or it might be more appropriate to pass on to the spouse for then the nil rate bands to come in on the death of on the second death. So again, looking at the various options around that. Gifting, where there's a separate question on next, but making gifts in their lifetime, so they're both in good health. They might want to help out their children now while they're able to. As I said, they're in a fairly comfortable position in terms of their overall assets, and they've got relatively low outgoings based on the case study, so there might be the potential to make gifts without reducing their standard of living. Gifts out of income as well, so things like the husband's defined benefit pension, if he doesn't need all those funds, there might be an option to give regular gifts out of that for the IHT exemption. Mentioned already, trusts could become an appropriate option, so they might want to put some funds in the trusts for their children if they didn't want to gift outright at this stage. So again, you can go into a discussion about looking at the different types of trusts, whether it's kind of absolute trusts or discretionary trusts that gives some kind of retained control over that. So again, you can just go into detail a little bit there to just evidence that you've got that knowledge around trust planning as well. So again, just showing the examiner that you've considered all the various options. And then life insurance as well. So protection is quite a big element in one of the RO modules. So then again, just showing around whole of life policies written into trust, things like that to cover off IHT liabilities. Again, just evidencing that you've got the knowledge around all the various financial products that could potentially support these clients. The fourth question was around gifting in detail. So explain how gifting could be used as part of estate planning. So a question like this is asking you, what are the options around gifting? How do they work? So this is where you can go into some technical detail in terms of explaining what gifting rules are, what the kind of amounts are in terms of annual allowances or regular time periods, things like that. So you can go into a bit more technical detail to explain how each of these options work, and then linking it back to the case study to say which ones may or may not apply, or may or not be beneficial for the example clients under the case study. So a couple of examples on here. So we've got potentially exempt transfers or pets. So you could go into detail explaining how the pet rules work. So larger gifts will stay within the donor or the person who made the gifts estates for that 7-year period, but the IHT liability will taper down over that 7-year period. So this could be potentially, if we're looking at our scenario case study, could be a good option for our example, because we were told they're in relatively good health. They're both relatively young, early 60s, so their life expectancy should be 80 plus. So again, just answering the question, you could say, look, if they did want to help their children out now while they're younger, they could potentially look at using some gifting, and now at this stage, hopefully to survive that 7-year period. And then that gives completely outside of their estates for IHT purposes. So again, you're evidencing your technical knowledge around gifting rules and then applying it to the client's scenario. So why it would be beneficial for them potentially. So coming up with that financial plan. Mentioning the annual exemption as well. So everyone has that £3,000 limit, which can be carried forward a year as well. So again, just evidencing that you have knowledge around those gifting rules, and again just applying it to the client scenario, how it might help in their example in terms of reducing their IHT liability. Similarly with the small gift exemption as well, so that can be outside of just their direct family as well. So if they've got other people they might want to give small gifts to, again you can just mention that in the exam question, in the answer, and again it's just evidencing your knowledge around all those issues. Normal expenditure out of income as well. So these rules are a little bit more complex. So again, it's a good opportunity to say, right, I've understood how these rules work, how it would apply to the client's scenario. So you could build an example answer around, the defined benefit pension that the husband has. He might not have need of all that. What was it, £38,000 a year? He might work out that his actual outgoings is around 30, so he's got kind of an 8,000 buffer that he doesn't need each year that he can evidence, and with his financial advisor can say this is expenditure outside of income, so the income that they don't need, that could then be gifted away and it doesn't count as a potentially exempt transfer. Again, so you can answer your question showing that you have knowledge of the potentially exempt of the normal income out of expenditure exemption, and then how it would apply to the client and in the case study again. So again, there's no right or wrong answer potentially with these questions, but they do give you the opportunity to sort of show that you've got that technical knowledge and how you would actually apply it based on the scenario that the case study gives. And then the last question was around the investment portfolio and how that was structured to meet their objectives. So again, this is quite a common question, and it's all around kind of portfolio theory. And if you've done those kind of you've done the syllabus around the kind of investment planning, you'll be familiar with that, but there's lots of kind of key areas again just to tick on. So things like diversification, that's part of the portfolio theory. So maintaining the asset mix, making sure it's appropriate. So as I already mentioned, switching down the kind of volatility rating. So as someone does age through, their attitude to risk typically will diminish. So they want less volatility when they are relying on those assets for retirement. So as I said, switching from equities into bonds and into cash and cash-like investments, reducing that risk. That's kind of a model answer in terms of people at that stage of their retirement journey. Tax efficiency as well, so using the investments in the most tax efficient manner. As already mentioned, the ISA is obviously kind of the primary tax wrapper in this scenario, so tax-free withdrawals from the ISA. I've talked already about using the personal allowances for the pension schemes as well, so again building in that tax efficiency to how the investments are set up as well. We've mentioned the liquidity issue as well. Again, that's kind of a key point, making sure there are some short-term cash essentially there ready to be dipped into. So if there are any unforeseen costs that come up, sort of that concept of having an emergency fund to cover you, the liquidity, having it in cash so you don't have to break the investment management of the other investments. So again, that's something that potentially the exam moderators will be looking out for, making sure you've understood those concepts. Sustainability, again, another key concept. So income generated funds potentially for the retirement portfolio, natural income from other assets as well. So how to avoid that capital erosion. So again, if you're linking that back to they want to leave funds, pass legacy funds onto their children, they might not want to actually dip into the main capital, so they might want to live off the income of their assets that they've got, with that capital being ring fenced to be left to their children as part of that IHT planning. So again, just linking all the elements together. And then obviously one of the other key points, regularly reviewing, so checking that the portfolio is still suitable for the client's needs. So as I said, attitude to risk could change, also market conditions as well, so reviewing it in line with how the market's performed. You know, if things dip, if market conditions change, then it is worthwhile re-evaluating the portfolio. So again, just mentioning that this is a regular ongoing process rather than a kind of one size fits all. Keeping the top on those regular reviews is always going to be important. So again, mentioning that hopefully will be things that lead to marks from the examiner. Cool. So that was quite a sort of a whistle-top going through of how these exam questions potentially work. As I said, there's no kind of real perfect model answer to these questions, but hopefully that's useful in terms of things that the examiners potentially will be looking for. Just make sure you're mentioning those kind of key points, always kind of evidencing why you've mentioned something as well, rather than just, you know, putting out, you know, endless amounts of answers when you are answering the questions, kind of linking it back to the case study all the time to sort of show that you've understood the client's situation and this is why you think it would be appropriate in your opinion. Just some other wider kind of exam tips then. So as I said, you'll get 2 case studies usually for the exam, and so they'll look similar to that one that we've just been through. And obviously, as I mentioned already, based on the case study, you can kind of tell roughly where the exam questions are potentially going to go. So our case study we've just been through was for an older couple looking at retirement planning and estate planning, so you can kind of work out where the questions are going to be. As I've said, if it was for someone younger or someone in employment, those kind of things, they'll be looking potentially at testing on different elements as well. So make sure you have a good detailed look at the case study ahead of the exam, and then think about what you think questions will be able to be generated from that as well. And then you can go into the exam in quite a good position of hopefully already knowing or having a good idea of what the questions are actually going to be. So 150 marks in total. It's a 3-hour exam, which seems like a long time, but they are quite detailed questions, so that time will go quite quickly, you would expect. This is another key point. The questions are really looking for you to analyse the situation, make a recommendation, and then justify that recommendation. So I think if you answer each question based on those 3 key elements, so you've understood what the client scenario is, you've analysed it from that analytical thinking, you've made a recommendation based on your analysis, and then you've also justified your recommendation as well. So you've said the client has this issue, this is how they could fix it, and this is why that would fix it in their situation. So I think if you try and keep to that, it's obviously not always going to be as straightforward as that, but if you try and keep that as the kind of your principle when answering the questions, that's quite a good grounding to kind of get the marks from the exam you would expect. As you'll probably know, you do get the case study a couple of weeks before the exam, so it does give you an opportunity to kind of drill into the detail, think about what those questions are going to be based on the client scenario. As I said, it's usually quite easy to determine what the kind of the scope of the questions is going to be based on the client situation, so you can hopefully go in fully prepared for what the questions are going to be about. I mean, this is all pretty general, straightforward stuff. So the syllabus, it's quite, as I said, it's obviously RO1 to RO5 that is going to be tested on, which is quite a huge amount of information so it's quite difficult to kind of recap on all those exams. You've probably studied a few kind of potentially even a year or a good few months ago, so it's worthwhile just going through the key points on the major study texts as well, though, just to make sure there's any that you're a little bit weaker on, just making sure you're going in and filling up that knowledge so you're in a good position when you go into the exam. The CII always say read widely as well, so don't just base your answers on the textbook, you know, things that are in the news currently or general planning scenarios. So things like the change in pensions and IHT will be a key thing, so you can mention that in your exam, sort of say that you're aware of that, and I'm sure that there'll be marks for that as well, so you're not just basing on kind of static information. Looking at kind of the real world examples as well will be useful. Obviously mock exams are really useful in terms of looking at the style of the questions and how that work. I'm sure you'll be familiar with those. Things like the tax tables that are provided, so they'll give you quite a bit of information within the exam, so just make sure you're comfortable with how that information is presented, because you obviously need to refer to that in the exam as well, so just make sure you're comfortable there. Practice the key calculations as well, so things like income tax calculations, so taking off the personal allowance, the tax bandings, things like that. Relatively straightforward maths, but if you're in the pressure of the exam situation, you can fumble those quite easily. So again, just make sure you've got the basics ready so you're in that full position where you're comfortable in the exam. Things like consumer duty as well, and that kind of client focused bit. Obviously that's harder to kind of put forward in exam questions, but because I mean obviously RO1 is about regulations and that kind of thing, so have a look, think about things from the kind of the FCA perspective as well, so things like customer outcomes, mentioning those kind of consumer duty elements as well. I'm sure there'll be marks for that as well, because you're having that kind of consumer duty mindset, which is very much one of the FCA's key mottos at the minute. And then lastly, sort of when you're doing the exam itself, you'll have the case study to refer back to as well. So, obviously, hopefully you've studied it in detail, but you'll be able to go back and anything else that you might have not thought about. And then, once you've got the questions, you can go back over the case study to things that might be relevant more once you've actually seen the questions itself. In terms of answering the questions, bullet points are very good. Just get your point round succinctly rather than kind of droning on in lots of kind of long sentences. That's easy for the exam markers to actually look around what you've actually put. So keeping answers nice and concise, make sure you're hitting those points around your analysis and that recommendation again. Try and allocate your time based on how much marks are given on each question. Another good tip, if you're struggling on a question as well, perhaps just jump to the next question where you're more comfortable, and then if you've got time to go back at the end, you can do, but look where you're going to score the biggest points. I think it's always a good shout. So if you're one that you're more comfortable with and you think you're going to get the bigger points, focus on your time on that than something that you might struggle with more. And then another kind of no-brainer is always show your steps in the calculations as well, because that shows how you got to the answer. So that's always a kind of a key exam point. Yeah, so hopefully that's useful. Obviously, it is a tricky exam, RO6. At the end of the day, if you don't pass it the first time, you can always do the resit in a few months. So it's not the end of the world. So don't stress about it too much. But hopefully that's been useful. As I said, there's no real right or wrong answers in terms of answering these questions. But hopefully that's just giving you a kind of a quick overview of things that we think you should look out for, and how applying sort of that technical knowledge into the kind of case study can help. So, as I said, yeah, I hope that's been useful. Any questions or queries after the session, feel free to reach out, and we'll come back to you after the session's been played out today. But yeah, thank you very much for your time. We'll see you on the next one.
Thank you very much, Josh. And that concludes today's webinar. So really appreciate how busy you are. And as always, we're grateful for the time you took out your day to spend with us. As I mentioned earlier, your CPD certificate, a copy of the slides, and a link to rewatch today's webinar will follow via email within the coming days. So we'd really appreciate it if you could give us your feedback form today on the form that will pop up very shortly. And we really do use your answers to tailor our future events. So all that's left from me for today is to say one final thank you, and hopefully we'll see you at the next one. Bye for now.